Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN Sunday. I'm going to be joined this week by members of the media, financial services, and academia as we analyze all the news in retirement markets, technology, personal finance, so much more. So sit back, relax, and enjoy this episode of BRN Sunday. Well, joining me now to discuss this and a lot more is Rick Seltzer. He's an editor with Inside Higher Ed. Rick, great to see you. Thanks so much for joining us on the program this morning.
Great to see you too, and thank you for having me.
Yeah, it's always great talking with you. Higher education, really an important part of what we do here in America and learning and trying to better improve ourselves. A lot of talk, though, Rick, on forgiving student loan debt, and I know you just wrote a story on this and really looked into it in deeper detail. What can you tell us?
Right. We've had a couple of interesting windows into how the student loan market or the student loan portfolio is functioning right now. Most recently, the Wall Street Journal had a report on a consultant's report that the Department of Education commissioned on its federal student loan portfolio. The federal government issues and holds almost all of the student loan debt in this country, or the vast majority of it, since some changes to the law about a little more than a decade ago. So this is a $1.37 trillion portfolio as of the beginning of the year. It's bigger now, but the snapshot was starting at the beginning of the year. And this report essentially calculated to find that the feds can anticipate about $935 billion of that $1.37 trillion being repaid, leaving taxpayers absorbing about $435 billion.
Wow.
Now, yeah, it's a big number.
Very big.
Now, what's driving that is going to be the obvious question, right? And the answer essentially is income-based repayment programs that end in debt forgiveness after a decade, 2 or 3. That's where most of this write-off is coming.
I mean, that is just a significant number. And I know there's been some talk in the Congress and elsewhere, maybe a new administration, about student loan debt forgiveness. But, it's a little hard for me to understand, and maybe you have some more details and answers from some of the studies. You just walk away from this debt. Who pays it, right? The taxpayers. You, me, other people who are paying taxes, right? So I guess I'm not understanding the logic behind it, but I need to be educated clearly. So tell me what else I should know.
Yeah, it's very interesting, and I would say right now that sometimes this gets cast as a right versus left issue in ways that it isn't that clear. There are some thinkers on the right who actually argue we're already doing debt forgiveness for the people who need it the least, while leaving those who need it the most to pay for years and years because they cannot keep up with their payments. A lot of this is really numbers on a page. I know that sounds awful, and it is numbers that you can base future budget projections on. But essentially, what's happening right now is the feds are issuing the money to colleges so that students can enroll, and then the students are paying it back either on a fixed payment plan or on a graduated plan based on their income. And that graduated plan based on their income is where you're seeing some of this variability in payback over time. And it isn't any one moment where this debt all accelerates and comes due for us. It's just one of those things where, like anything else in the federal budget, there's a little deficit versus what was expected, or it comes in a little higher than what was expected. And the feds make up for it by borrowing from another program, or taxes, or by issuing debt of their own. So it's a very complicated accounting process going on here. To me, that number really crystallizes how this system isn't necessarily working for either side, the student or the federal government.
Yep.
Because you have students who, in some cases, are paying high tuition. They're not feeling that price transparency when they're enrolled in college because it's debt that they'll pay back later. Then when they get out, many of the people who struggle to pay it back the most actually never graduate, so they don't get that wage bump that you see from having a degree. But the largest dollar amounts are actually for people who go on to graduate school and take advantage of some programs that have no borrowing limits for graduate programs. Then they get out. Sometimes they get a wage bump. Sometimes they don't. They can enroll in a income-driven repayment program, and it may be 10 years, it may be 20 years, maybe 25 years, maybe 30 years, depending on some of the variable programs and the details, before they ever finish doing that. And at the end of that, their debt may be forgiven. To the government, it looks like there's a large percentage of it that gets written off. But if you're paying back a loan based on your income for 25 years, you probably don't feel like much is being forgiven either. So I think there's an interesting perception gap there, and there is potential for a lot of unhappiness going forward.
Yeah, well, I think it's just a burden. We've talked about this on and on, and I think a lot of people feel like if you have this hanging over your head, meaning the debt hanging over your head, and all your earnings, or a lot of your earnings are going outside of your living expenses, go towards paying off this debt, what are you going to have for yourself in the future, right? What are you going to have for retirement? What are you going to have to build a family, buy a home, all these other things? You literally have to put things aside. So clearly, this is a big issue. And, I just want to pick up on something that you mentioned at the outset, which is that there are some people who are just getting their debt forgiven that don't need to get their debt forgiven. I mean, is it time? And look, we just went through things with the CARES Act, right, that delayed payments or suspended payments for a period of time. And I guess we have yet to see whether or not that gets extended, right, because that's part of this, what we're hearing is a new stimulus bill. But, is it time really just to kind of, I don't know, blow things up? Is that the right word? But merely overhaul. I'll use that word. Overhaul this system to something that is a little bit more equitable and favorable to everyone.
Yeah, I think we're in an interesting place with it, because I think groups on all sides of the aisle would like to have an overhaul that would create a more equitable system, one that doesn't necessarily forgive debt for the people who have the highest earning potential or the highest degrees, but forgives debt for people who, actually struggle to repay and maybe never graduated from college. The problem there is, I think there's a lack of trust on different sides. I think there is an incentive for the higher education sector to continue to draw funding from the federal government. Most places could not continue with their operating budgets the way they are if they did not have federal support. So if the federal support does not come in the form of loans, what form does it come in the form of? Someone has to take the risk in this system for paying to educate students when they are 18 to 24 years old. And 18 to 24-year-olds are a risky bet. It's difficult to underwrite that borrower because they don't have a history of borrowing, and it's hard to project what the labor market's going to look like for them going forward.
Yeah, and I left out, and I think you brought it up in a nice way, which is the schools have a part to play too. They have very high tuition. Maybe they need to look at their infrastructure and what the costs are. So I think there's a lot of people here, a lot of folks here around the stakeholders, I should say, around the table that need to kind of work through this. Well, Rick, I want to go to a very quick commercial break. When we come back, we'll talk about university employees using the social safety net. You're going to want to stay tuned right here on BRN AM. Yeah, Rick, I mean, that's a huge story. I mean, this burden shouldn't be over people's heads, but I also feel like people may have made a bad decision. They wanted to go to the Harvard. They wanted to go to a very expensive school, pay $65,000 a year, $45,000 a year. So there's like this happy medium that needs to be balanced, and you need to maybe temper our expectations. We talked about two-year schools, right? I mean, I don't know. I feel like we all have very high expectations for ourselves, but sometimes we don't live up to them.
Yeah, well, there is a huge kind of thrust in a more, esoteric discussion right now about kind of the failings of the meritocracy system that we have right now, and all the things that we heap on students when you're 18 years old, go to the best school, when maybe a two-year institution is the cheaper way to do it for you for a couple years. But
I think
it's one of those situations where you start to pull the string out, and different parts of the education system would really start to unravel. So there are all sorts of knock-on consequences, that some of which may actually be net positives for society, but it just makes it really hard to move this thing.
Yeah, well, I think this is part of the large. I know this is probably a policy issue that'll get discussed in January and throughout. I mean, this is something that's going to continue to come up, especially with 1.3, 1.4 trillion dollars. All right, let's bring it back. I'm really interested in this story about social safety net. So let's do it.
Great.
What time it is? Here we go. 3, 2, 1. Welcome back. We're talking to Rick Seltzer of Inside Higher Ed. Rick, thanks so much for staying with us this morning.
Thank you.
So as I teased when we went to commercial break, I mean, this is a story that you wrote that I'm very, very interested in. I was very interested in student loans, but this one is that there are university employees who are using the social safety net in their states. What can you tell us here?
Yeah, this is based on a Government Accountability Office report that came out a few weeks ago. And it essentially studied employed adults who are nonetheless enrolled in 2 public safety net programs, or one of 2. Medicaid, which is the insurance program for low-income individuals, and SNAP, which is better known as, or formerly known as, food stamps. And you might have seen discussion on this issue as it relates to the largest private for-profit employers in this country. And by that, we're talking about your Walmarts, your McDonald's. They get a lot of criticism for not paying their cashiers, say, a living wage that would allow them to feed their families or have health insurance, or they get criticized for not providing health insurance. And instead, they get criticized for relying on indirect government subsidies like Medicaid, like SNAP, so that their employees can afford to eat or afford to visit the doctor, can essentially afford to work for them. And we can talk about the merits or the non-merits of that discussion, but what's interesting now is the GAO looked at the largest employers of working adults working 35 hours or more a week who are receiving Medicaid and SNAP benefits in several states that provided good data or reliable data. And in addition to those private employers, like the Walmarts, like the McDonald's, the Dollar Trees, it also picked up on some major research universities in several states. Indiana University, Purdue University, the University of Maine system, the University of Rhode Island, as some of the largest employers in their state of working adults on these 2 public safety net programs. Generally speaking, I reached out to the universities that were on these lists, and generally speaking, their response was they're among the largest employers in their states, which is absolutely true, and their workers have a variety of skills and income levels. A few of them said we are working to try to pay people more. Indiana University, I believe, said we have a plan in place, have had one in place since 2017, but the pandemic is setting us back, but we're going to get back onto it. So you see a really varied picture here and a really more detailed picture of how the labor market is playing out on some of these colleges and universities, where we often see the president, or we often think of the high-powered researcher or physician who works for their medical center, but they employ janitors too. They employ other staff members. They employ food service workers. And generally speaking, they will often employ them at whatever the predominant wage is for that field.
What's really interesting, and you really, when you led into this, I mean, you often hear about the Walmarts or Targets that are employing people who are, in a lot of cases, living below the poverty line or having to take advantage of these programs. You never, ever, up until I started talking to you about this, had I heard about this. And, I just think about some of the wage gap that exists in private sector, but also the wage gap sounds like that exists in public sector, and specifically public sector higher ed. But when you think about it, the taxpayers within a state, they are subsidizing higher education, but also in another vein. So they're actually footing the bill for both sides of this equation.
Yeah, it's if you pull back the lens, you can almost think about it as a way of which route you want the taxpayer to be doing the subsidy. And the question ultimately is, what is the most efficient route one of the questions is, what is the most efficient route for the taxpayer to be providing the subsidy, or should the taxpayer be providing the subsidy? Because these institutions do have very high paid employees. I don't have the data in front of me for any of them right now, but you look at some of the executives, you look at some of the wages that they pay different people. In some cases, the benefits that they provide to other groups of employees, and there is a real disparity there. So the question is, how do you want to pay for these programs? How do you want to pay for these benefits that, as of right now, we as a society have programs in place to say, here is the minimum level that is available to folks?
Yeah, well, let me just, I'm old school, but, it's a social safety net for a reason, right? It is there in case you need it, but you're not supposed to subsist on it. That was the purpose of Social Security. That was the purpose of some of these other programs, right? Now, times have changed. Maybe there's a different point of view on that for some people. But, you bring it up. If you're a college professor doing research, I guess the question here, Rick, is when you're thinking about benefits and deriving benefits, it's compensation, wages, bonus, if there is a bonus, and healthcare and whatnot. All that should be factored in my opinion. Again, call me old school, whatever. I'm not even that old, but call me old school. And when you line up compensation, you have to think about all these things together, not push that off into, okay, well, these people are going to earn this amount of W-2 earnings, and they're also going to pull in money from SNAP and Medicaid. I feel like they need to be completely diverged from one another. That's just my opinion. I'll give you the last word.
Well, I think there's certainly a strong argument for that. And I think there's also a strong argument for, I was very surprised when I started reaching out to the universities. I really think a lot of the officials there didn't know. They didn't have data on this. They didn't have good data, or they had to scramble to try to figure out what was going on. A lot of them couldn't tell me who exactly these workers were, right? I wanted to know how many people are food service workers who are under this. I didn't get that information. And the other thing that's going on is a lot of these universities have sought to make their budgets balance by outsourcing certain employment. So a lot of places will contract with a food servicer. That wouldn't necessarily have shown up in this GAO report. So I think some of this is maybe undercounted. And I do think maybe some accountability, some more understanding of the structural way these things would work would allow major employers, including public universities and probably some private ones too, to have a more responsible structure for how they compensate their employees and what benefits they provide.
Yeah, well, excellent reporting. It's something that I never knew about, never even thought about. I'm sure our audience, many members of our audience probably as well had never heard of this or thought about it. Rick, great reporting as always. Good to talk to you. Stay safe, and we'll talk to you again very soon.
Thanks so much. Be well.
All right, Rick, this is going to be Monday's show. I'll send it to you, and then maybe I'll send you a quick note. Maybe we can have a conversation offline about what we're doing at BRN, and maybe it'd be of interest. Maybe it's something of interest to Inside Higher Ed.
Definitely. Sounds good. I will take a look at that note. Appreciate it.
All right, bud. Have a good rest of the week, man. Thanks again for your time.
You too. We'll see you.
Bye. Welcome back. Now, time to take a look at some of the biggest social media trends this week. And on the line is Senior Financial Services Editor for LinkedIn, Devon Banerjee. Hey, Devon. Great to talk to you again. Good morning.
Good morning. Always great to talk to you, Jeff.
It's always a pleasure. So, a lot going on. We had you on the network this morning. We're talking Friday afternoon Eastern time, and I guess Friday morning Pacific time. But new developments. What's top of mind for you and the team this week at LinkedIn?
Absolutely. A lot of new developments, a lot of interesting trending stories related to finance, investing, saving, retirement this week. So it is Friday morning, and it's the first Friday of the month, which is the jobs report. Mm-hmm. The jobs report looking back at November, of course. You'll probably see the word disappointing associated with that news quite a bit today and this weekend. The number coming in quite far under expectations. Let's see some takeaways here. U.S. employers added 245,000 jobs in November. Sounds like a lot, but that's actually a fifth month of decline. Of course, amid this coronavirus surge. A couple other takeaways here, Jeff. So the unemployment rate did tick down a bit to 6.7% from 6.9%. But a lot of people point to that number being kind of not inflated, but supported higher because a lot of people are dropping out of the labor force. That participation rate, which is the share of Americans either working or looking for a job, which is the denominator in the unemployment rate, that number fell in November and remains far below levels seen before the pandemic. About 400,000 folks have dropped out of the labor force. And of course, you and I have talked about how disproportionately that number of people has typically been women, mid-career women who are stopping working because of childcare duties and other duties during this ongoing pandemic. What's also interesting, though, Jeff, is some economists are starting to point to baby boomers who are still not quote-unquote retirement age, but choosing to retire early. Some of them who have lost jobs over the course of this year are deciding not to even try re-entering the labor force, and so that keeps them out of that participation rate. So in the third quarter of this year, about 3.2 million more baby boomers said they were out of the labor force due to retirement than in the same period a year earlier. That's according to Pew Research. And over the course of this decade, from 2011 to 2019, the number of retired baby boomers has been rising at a rate of about 2 million annually. But as I just mentioned, in the recent quarter, the third quarter, that number is ticking up a lot. So, of course, many implications for that. You and I have talked about how many of these people want to be working longer because they need to save more for their retirement. But unfortunately, a lot of them are dropping out of the labor force if they've lost their job already.
Devon, what about and I don't know if the jobs number picks up on this, it probably does not, but we have talked about gig workers, that gig working has seen a tremendous growth. And we've also talked about people wanting to extend their career. Maybe they just decide to drop out of the labor force in terms of traditional jobs, and maybe they go and create a sewing business or a greeting cards business. I don't know. I'm coming up with the ideas. Maybe that doesn't necessarily get picked up in those numbers?
Yeah, I'm actually not sure how exactly that stuff is classified. I mean, of course it's maybe not showing in private payrolls that are being reported, like through the ADP report, which of course has all the big and medium-sized companies in there. But yes, I mean, other data that we have featured and reported on certainly does show that the entrepreneurial spirit and those who are applying to the IRS for a tax number for a small business is on the rise. And so there certainly is a shift occurring there. And I think and what's interesting, as you and I have talked about, is we're seeing that happen across the age spectrum. So younger people who may have already been predispositioned or already interested in gig work, that's not surprising, but we're seeing it among the boomers. I mean, they have built up many skills over the course of their career, and they're realizing that they can apply those skills as a consultant, advisor, or some of the work that you mentioned, doing stuff with their hands. And so we're seeing that pick up as well. One more important point to mention, going back to takeaways from the jobs report, because the reason this is important is because it's kind of a disturbing hallmark of the last Great Recession, the one about 11, 12 years ago. And it points to the permanent scarring that can occur in the economy, which you and I have talked about. And that's the shift toward permanent job losses. So a large group of people who have been unemployed for, I think, more than 27 weeks, that long-term unemployed figure is really ticking up. The total number of people who have been out of work for 27 or more weeks increased by almost 400,000 to 3.9 million, and that's now accounting for about 37% of the total unemployed. So that's what a lot of economists and labor market watchers are looking at most closely, because of that permanent effect after a recession, after the technical recession ends.
And I was going to say, I mean, that just shows we talk about stimulus, right? And the fact that we haven't gotten a second or third round of stimulus. This is why it's so needed, because these people, maybe they can't find a job, Devon. Maybe they're a restaurant worker or a hotel worker. Hotels aren't really doing any real business, right? So they don't really have another opportunity. And so that's why this extension of benefits at the state level and the federal level is important.
Yeah. One more story I'll highlight, Jeff, that's quite popular right now. It's right up your alley, or
Sure.
in your wheelhouse. And that is companies are turning back on those 401k contributions that they had either paused or eliminated as the pandemic took hold. and as the economic downturn took hold. So you and I talked about when that occurred about 6-7 months ago, I think, on this podcast or on the network, and we're starting to see companies return to contributing to employees' 401k plans. So a couple administrators and record keepers, so T. Rowe Price Group, for example, said about 1/3 of those that it saw suspend or reduce matching contributions, about 1/3 of them have either already reinstated the payments or plan to do so by the end of this month. Only 1/3, but also good news that it's happening. The record keeper Ascensus says that 21% of the employers that use its services had suspended their contributions between March and September, and 2/3 of them have already restarted them. And it's interesting, in contrast to the last financial crisis, again, about 11, 12 years ago, fewer companies have reduced or suspended their matching contributions this time. And so that was already good news before these companies started reinstating them. But I mean, some of the large companies we've seen, Quest Diagnostics, the lab testing company, had suspended matching contributions to its plan back in April. But as its business has recovered, patients have returned to medical appointments this summer. It reinstated those contributions just in August, and that was 4 months ahead of its plan. And we've seen this at some other big companies. Let's see, Arconic, the metals manufacturer, Hewlett Packard Enterprises. A lot of them are starting to restore that ahead of time. A lot of them had thought they would do it in 2021, and they've already started doing it. So a good sign about businesses recovering. As some people were commenting, some CFOs and controllers on our trending item, they said it's unfortunately often one of the first things to go when the P&L gets squeezed. And so it's a great sign to see those coming back.
Yeah, and it's such a disincentive to the employer match. The matching contribution is an incentive for people to participate, right? If you get 50% on the first 6%, all you have to do is you put in 6% of your money, your company gives you 3%. That's, by the way, the most popular match formula. So, when you take that out, you create a disincentive to not participate. Or, okay, well, I'm only going to contribute 6%. I'm not going to get my company, and I may not get a profit-sharing contribution. It can really work against you in terms of long-term preparedness. But look, at the end of the day, Devon, you got to keep the lights on, doors open. You got to do it. You got to prioritize what's important. A lot more challenging for a smaller business than a larger business, I think, in this environment.
Yeah, definitely. But one last interesting point I saw in the reporting is that some companies are realizing, as they themselves think longer term, they're realizing that reinstating 401k matches it actually benefits them in the long term because it reduces costs associated with delayed retirement, which would happen to employees if they were not saving enough. So, higher payroll costs, higher health insurance expenses, those all can be and are associated with employees delaying retirement. So it is very important for companies to prioritize to the best they can employees' progress toward retirement.
And also, it's tax deductible. So the corporation can take a tax deduction from it too. So, obviously, or not obviously, but, CFOs and COOs and CEOs have to do, and HR members have to do. I'm sure they're prioritizing these things. I'm not, I don't think anyone goes in and just rushes in and say, okay, we're not going to do the company match. I think that a lot of this is thought through, but I would think when you think about these long-term domino effects, you're absolutely right. It's a disincentive to save, and it actually can hurt you in the long run if you see a rash of people retire or leave your firm and go elsewhere. Devon, always a pleasure chatting with you twice on Friday. Well, we're playing this on Sunday, but always great talking to you twice in a row. Really enjoy the thoughtful content and thoughtful analysis. Have a great rest of your week. It's not that much more to go. And have a great week, and we'll talk to you again next week.
Sounds good, Joe. Take care. Bye-bye.
Welcome back. Now time to talk a little markets. Joining us on the line, he's the co-founder of Delphi digital cryptocurrency research firm, Mr. Kevin Kelly. Kevin, thanks so much for joining us on the program this morning.
Yeah, thanks for having me, Jeff.
Always a pleasure talking with you. Hope you had a great holiday. Let's jump into markets because I think we've seen this week a little bit up and down, but as we're talking on Friday afternoon at 1:15 p.m. Eastern Time, markets are up over 30,000. You look at the Dow Jones Industrial Average. But just curious for your assessment, maybe some key themes for the week.
Yes, I mean, you had the kind of disappointing jobs number today. People kind of looking through that. Despite that, you've got the S&P, to your point, really pushing up to new all-time highs. I think part of that, too, is you've had inflation expectations, which people have been watching really closely, start to move higher, which is starting to push up long-term yields on 10-year treasuries. And so why that's important is you're seeing a bit of sector rotation within the equity market, which is actually pretty important if you want to see this rally kind of continue to have legs to it. But I think what's interesting is now we're at this point where you've obviously had the vaccine news that is starting to be processed. Obviously, on a day-to-day basis, there's different information that's coming out. But by and large, it seems like the market's kind of looking through some of that. But the jobs number, I think what's important there is that when you look at the FOMC meeting in December that's coming up for the Fed, as well as what we're going to be looking at on the kind of fiscal stimulus front heading into 2021, hopefully we get something passed relatively soon. I think that opens the door for more kind of accommodative, both monetary and fiscal policy. And so a weaker kind of labor market certainly helps to, I think, solidify, potential support for being more accommodative with some of those policies. And so that's going to be, I think, kind of a key driving factor within 2021 for us to, potentially realize this, back half of 2021 reflation trade that a lot of people are talking about with, global growth kind of coming back, at least trying to get back towards, pre-COVID levels. I do think it's going to take us, quite a while, probably well into 2022, but the general kind of sentiment towards economic growth is certainly turning higher and becoming more optimistic next year. And part of that is around these, continuation or sustainability of current loose monetary and fiscal policy.
Kevin, how do you build into your thought process this? You mentioned stimulus, and hopefully we get something out of the Congress soon and signed by the president. But what about funding the government? Because I believe that we have a deadline of December 11th, so that'd be a week from today, if I'm not mistaken. How do you build into that into your thought process in terms of looking at the market long term?
Yeah, I mean, for me at least, a lot of it comes down to what the, longer term implications are from a kind of treasury issuance supply demand standpoint, right? And we talk a lot about fiscal stimulus, and obviously in order to increase or ramp up that spending, the government has to basically issue treasury bonds and treasury debt to essentially finance that. And so the interesting dynamic here is that if you separate short-term versus long-term, in the short term, we're actually at a really interesting point, because when you look at what we would consider to be kind of available liquidity in the market, you actually have, $500 billion plus in treasury issuance over the last, let's call it 30 to, I believe, 40 days or so that we've seen, whereas the Fed's really only buying about 80 billion in asset purchases every month. And so you've got this really kind of large potential liquidity imbalance that in the short run could actually lead to things like flash crashes or potentially a correction, within risk assets and equity markets. But over the longer term, this kind of narrative around, and this is where, Bitcoin and gold and all these kind of precious metals plays ties in, this narrative around increased treasury issuance, unsustainable public debt levels, and then currency debasement really kind of being the escape route of choice or the safety valve that relieves pressure on not only the U.S. economy, but the global economy, kind of ties into the longer term narratives that we've been preaching for a while. So again, important to separate short term versus long term. Also not, investment or trading advice, stick to the plan. But,
Sure.
If you do start to see a bit of volatility tick up, which we're expecting to at least, through at least the end of this year, maybe even to the end of January, there are, potential legitimate reasons for that. But long term, I mean, our thesis around a lot of our core themes hasn't changed.
All right, Kev, let's switch gears, talk a little bit about cryptocurrency. Bitcoin has had a great run recently. What do you make of it, of Bitcoin, but also crypto in general?
Yeah, I think, we've hit a new all-time high officially, at least intraday. We've now seen a bit of consolidation over the last week or so. I think, again, separating short-term versus long-term, in the short term, there's a couple different technical indicators that are pointing to potential correction or further consolidation, i.e. price declining from here in the short run. But a lot of the long-term kind of both technical indicators that we're looking at in terms of momentum, but also a lot of the what we consider on-chain fundamentals that we track internally at Delphi, and looking at things like long-term holders and tying in some of this kind of behavioral economic aspects to some of this on-chain data. Long story short, all of those indicators, or pretty much all of those indicators, are screaming largely bullish. So again, short term, you could see a bit of a correction. For us, that represents an opportunity for us to get in at more attractive entry level prices, because our long term thesis has never been stronger, and we have a lot of the kind of on chain fundamentals starting to really back up the long term kind of bull case.
Kevin, I saw a really interesting story a couple of days ago that retail investors between ages 25 and 40 in India are spending millions on trading in India every day on cryptocurrency. I mean, what's your sentiment from this? What do you? I mean, obviously, it's become very popular. It's clearly popular among this age range in one of the biggest economies in terms of people in numbers. But what do you take away from that? And is it happening in other parts of the world as well?
Yeah, so I mean, if you want to expand that out, other parts of the world, we're certainly seeing that, and the ethos around Bitcoin and crypto too, I think plays a lot into this, because this idea of decentralized networks, which at their core, there's a lot of kind of fundamental benefits to that, but one of them being permissionless access to some of these crypto assets like Bitcoin, right? So you can transact, you can send value, cross border, and there isn't an intermediary there that can basically deny that or hold up the transaction settlement process. That is a huge innovation. We're starting to see that type of kind of ethos seep into not only, you mentioned India, but even your emerging and frontier markets. There's a big kind of cohort of gamers down in the Philippines, for example, who are now playing blockchain-based games to actually supplement their income, right, and create a more sustainable life for them and their families. So there's these really kind of interesting pockets of innovation and adoption that are occurring well outside the U.S. that we certainly think is obviously bullish long term, but also I think lends a lot of credence to the ethos that Bitcoin and crypto and the whole digital asset space has been built on.
And you're seeing, not to interrupt you, but you're seeing Visa and others really. PayPal, I think, was another one too. Well, Visa just alone is creating credit cards that will support crypto transactions. So that to me, Visa is not a small company. I mean, one of the largest credit card providers, and they pretty much have cards everywhere. Everyone's got at least one Visa card, I believe. But that's a big sign too, that they will have the infrastructure in place to allow those types of transactions, so you can have cash and you can have cashless, more digital transactions too.
Oh, I agree. It's absolutely huge. And it's interesting, at a high level, just to see some of these companies you mentioned, PayPal, Visa, obviously a huge kind of announcement earlier this week. But also, other companies like Square that are a bit more kind of digitally native. A lot of these companies, I think they're getting to a crossroads where you can either lean into this new kind of paradigm shift, right, and take the Visa approach where you're trying to basically make sure that your company stays relevant in this new age, or you can shy away and dismiss all of this and hope that all these different market pundits and now really kind of prominent investors and thought leaders essentially hoping that they're wrong, because if they're not, this paradigm shift is truly going to be, as it sounds, a paradigm shift in not the way we interact with each other, but the way in which value is transferred and payment processing and all those types of things.
And the last thing I want to ask you is, I know Facebook, they have Libra, and is that set to move forward? I mean, that's a huge. Facebook's not a small company either, right? So when you look at launching a crypto, you've got Bitcoin at this run up. There are other cryptocurrencies that are doing well as well. Facebook set to launch in early 2021. What does that tell you?
Yeah, so you've got Facebook with Libra kind of rebranding to Diem recently. Not a whole lot of changes within that, but long story short, yeah, I certainly think it's going to go through. There has been some legislation around, specifically something called the Stable Act, that, not to get into too many details, but basically has drawn a lot of controversy within the crypto space, because it's essentially regulators coming out and trying to enforce any stablecoin issuers or those of which who are kind of transacting or involved in stablecoin activities registering as potentially chartered banks. And so there's a lot of things in the regulatory space that I think are still challenges or hurdles for Facebook and everything that they're trying to build with Libra and Diem now. But I do think it'll go forward, and that kind of multi-currency, especially central bank digital currency driven multi-currency basket is going to be something that's really interesting to see, not only how the adoption is, but if that becomes again a replacement for some of these other kind of potential reserve assets that we've seen, and what that does to U.S. dollar dominance, for example. So definitely a trend that we're monitoring.
Yeah, it's going to be interesting to see. Well, Kevin, I want to say thank you very much for making time out of your incredibly busy schedule, and we look forward to having you back on again next week for another catch-up.
Yeah, thanks, Chuck. Good talking to you. Bye-bye.
Welcome back. Now time to talk a little real estate. Joining us on the line is Market Watch's intrepid real estate reporter, Mr. Jacob Passy. Jacob, great to talk to you again. Welcome back to the program.
Glad to be here.
Absolutely. And from what I've heard, the real estate market, at least the home market, has been buzzing. But, whenever something comes up about real estate, you're the guy I like to talk to. So what can you tell us? What's the latest news this week?
Yeah, so an issue that's been kind of on the radar for the past couple weeks, and I believe you and I talked about before the Thanksgiving holiday, was whether or not we were going to see Fannie Mae and Freddie Mac returned to the private market and their conservatorship end. So, as listeners may know, Fannie Mae and Freddie Mac have been basically under government control since the 2008 financial crisis when they were bailed out. And it's, they are basically the biggest players in the housing finance sector. They're responsible for about half of the mortgages we see in the market today. They're not lenders themselves. They buy loans from lenders, but they're critical in providing, the funds necessary for the smaller banks around the country to be able to lend. And, it's been a priority for, a lot of folks to see them out of this, kind of government control situation they've been in, especially folks who are investors in them. It's tough if you had bought stock in them in the past. You basically have kind of just been sitting on that stock, seeing it kind of go nowhere because the value has not really increased at all. Because the big issue for many years now has been that all of their profits were swept to the federal government to repay the federal government for its bailout. And the federal government owns, preferred shares in Fannie Mae and Freddie Mac that give them that ability. So a couple weeks ago, there were these reports coming out that the director of the regulatory agency that controls Fannie Mae and Freddie Mac, the Federal Housing Finance Agency, its director, Mark Calabria, was reportedly considering, a plan to privatize them, take them out of this government control situation before Joe Biden enters the White House. I think the thinking was, Republicans are more inclined to see them exit conservatorship than Democrats are for various reasons. And I think the idea was that, you have to have lots of people sign off on a plan like this. And you can't just do it unilaterally. And so with the, other, representatives in the Trump administration being favorable, possibly to this, there was this idea that this might happen in a very fast timeline, much faster than anyone would have anticipated. And that caused the concerns. Folks, because of how many mortgages are basically backed by Fannie Mae and Freddie Mac, there were concerns that if this was moved, if this process moved too speedily, it could disrupt the, housing finance space, which would, make it harder to buy a home, make it harder to refinance. I mean, it would have a lot of, impacts for folks. This week, the news is there were two hearings on Capitol Hill, one in the House Financial Services Committee and another in the Senate Banking Committee that Steve Mnuchin, the Treasury Secretary, attended. And he was the hearings were ostensibly about, the federal government's response to the pandemic, the financial response. But he was asked in both hearings to comment on, this potential plan to privatize Fannie and Freddie. And what he basically said was that he thinks that they need to have an appropriate amount of capital before they could exit conservatorship. He didn't specify what he meant by appropriate, but generally speaking, most people observed that as him basically saying, I don't think they're ready yet. Because for so many years they had to sweep all of their profits to the federal government, they basically had no ability until about a year ago to keep any of their profits to themselves to build, a buffer so that they can, basically like a rainy day fund for themselves to fall back on if there was another, major downturn in the economy that affected the housing market. And so this is a big deal because it kind of means that we're probably not going to see this plan play out because the Treasury Secretary has to basically sign off on any plan to exit Fannie and Freddie from this government control. And it seems likely that Steve Mnuchin will not sign off on anything like that. He might, there are things he can do to ensure that they will exit conservatorship in the next few years. But there, which might limit, Joe Biden's ability to really influence the situation. But there's nothing, it's looking unlikely like we're going to see them, exit in the next, 50 days or so, which is good because, there were those concerns that this would, potentially disrupt, the economy. So positive news if you're looking to buy or looking to refinance right now.
Yeah, I was going to ask you, did you, at the even utterance of returning it back from conservatorship to private sector, did you see any movement in the market? Obviously there was some concern that you talked about, but did you actually see any price moves? Did you see, or not you, but did the market see any price moves as a result? Or was that just like it didn't react at all to the hearsay?
We didn't really, we haven't seen any moves in terms of mortgage rates, for instance. So that's a big way you would see, these changes be priced into the market. In fact, actually this week, mortgage rates hit yet another record low.
Oh, my Lord.
I'm getting tired of saying that, but it's true. It's the 14th week this year in which they've dropped to an average record low.
Yeah.
And that's according to Freddie Mac. So, we didn't see that priced in, but one thing that people pointed to, which it was a topic you and I discussed a while back, months ago actually, as kind of an example of what we could expect if something were to happen was, a few months ago, the FHFA, the regulator in charge of Fannie and Freddie, announced a new fee that it was going to impose on refinance loans to recoup the money that the federal government has basically lost as a result of the forbearance that was issued amid the pandemic. And that was quite controversial at the time. And what you saw when that happened is that you did see temporarily, obviously, mortgage rates spike. They went up quite a bit for a couple weeks there and then dropped back down, obviously, since they just hit another record low. This happened back in August. But that was kind of that kind of the experts I talked to said that served as kind of an example of what we could expect. So, because, mortgage lenders don't like risk, they don't like uncertainty. And a move like Fannie Mae and Freddie Mac being privatized in the span of, 4 to 6 weeks would sow a lot of uncertainty into the market. In the short term, it would, probably not a lot would change, but in the long term, certainly quite a bit could change. And for, a lender or a servicer who's holding on to mortgages for potentially 30 years, you're certainly looking to the long term. And so a substantial move like that would throw a lot of risk into the long term here. But there are things that are already happening that are changing the market, and we haven't yet seen the impact, the kind of impact to rates with those. In regard to all of this, the FHFA did put into place in the past few weeks a new requirement for how much capital Fannie Mae and Freddie Mac are required to hold. This is basically like that rainy day fund, like I described. They the FHFA has set a new standard for them in terms of the amount they need in those funds to basically cover a potential downturn. And it's basically, similar to what other regulators require banks to have in terms of fallback funds for, a crisis. A lot of banks have to go through, like the too big to fail banks have to go through stress testing and stuff like that. So it's a similar requirement for Fannie Mae and Freddie Mac. And because they're going to have to, bulk up their capital quite substantially, that could actually alter the types of loans they're willing to make. We could see certain loans priced out of the market. So those borrowers would go to other types of loans, whether it's FHA or, loans that lenders are just going to keep on their books. Those are called portfolio loans. A lot of this is kind of in the weeds, but what it means is, and what some folks are concerned about, is that we could see a significant reduction in lending from Fannie Mae and Freddie Mac. And if that happens, that would obviously be bad for the market. I mean, if they are pumping less money into the market, there are going to just inherently be fewer loans to go around. And so there are concerns about that, how that affects affordability. We could see mortgage rates go up and or other fees go up, and those, that would impact low income borrowers substantially, or first time home buyers who probably have less in the way of savings and might be they're not necessarily reaching their peak earning years yet, so they don't necessarily have the income to afford a higher monthly payment. So there is this risk kind of looming out there that we could see borrowing credit availability tighten in the coming weeks as Fannie Mae and Freddie Mac start to change their practices to account for this new requirement that they're facing. But it's not certain yet how that will play out.
Jacob, just kind of going back to kind of the more, and thank you for that, but in terms of like home sales, and let's get back to a little bit to that for the next, we got about a minute left in the segment, but how have home sales done? Obviously, we're kind of seeing a resurgence in the virus, and I remember back in the summer, things were kind of tamped down. You had to buy things maybe virtually, you had to really schedule a tour, wipe down, all those kind of things. Have you seen a resurgence in home sales, at least in part of the country?
So home sales are still pretty hot compared to what you would expect, particularly for this time of year. I mean, this is, we're getting into, December now. So it's, what is usually one of the slowest times of the year for home sales. And it's certainly elevated from where it was a year ago, for instance. But seasonality is starting to play a role here. A big issue right now in the market is, and especially when we're looking at, record low mortgage rates, you would think, well, that's great for buyers, that'll make things more affordable, et cetera. Mm-hmm. But we're still in this realm where there are just so few homes on the market. And with, virus cases increasing, that's not, there's kind of this, seesawing happening here, where on the one hand you have, all the great news about the vaccine, and on the other hand you have, these record-breaking, number of COVID-19 cases we're seeing, and that's probably going to play with the minds of sellers quite a bit. There's this theory that there's a lot of folks who might otherwise be inclined to sell their home right now who are just not, because they don't want to go through the hassle of having to buy a home themselves, or potentially be displaced, or even just have movers or people touring their home while they're still living in it, given their health risks involved. So there's this idea a lot of people have been just sitting on the sidelines waiting for the pandemic to basically end, and then they're going to rush into the market and sell their home. That hasn't happened yet, obviously. And so as a result, prices are going through the roof across a lot of the country. And that's, a major, issue for buyers right now. Even though mortgage rates are at record lows, we're basically getting to a realm where prices are rising so fast that even these weekly declines in mortgage rates can't keep up. So homes aren't actually getting any cheaper. And so, I think in going into the new year, the kind of expectation is that, while there's a lot of factors in place that would normally create a really positive, home buying market, the sheer fact that there just isn't inventory to go around is going to just limit things inherently. And so while sales, volumes will be, while there are going to be lots of people looking to buy, there may not actually be that many sales because of just the inventory situation.
Well, Jacob, you gave an extremely detailed answer. It's going to be interesting to see. I think there's a lot of obviously reaction and action because of the pandemic, and we're going to just have to see how things kind of unfold. It's always a pleasure chatting with you. We'll learn a lot on this segment of the show as we do in all other segments. Have a great rest of the weekend, and we'll talk to you again very soon. Thanks, Jacob.
Take care.
Welcome back. We're going to close things out, I should say, as we always do, with a visit from the Legal Eagles. Joining me on the line, David Levine, Kevin Walsh. Both are principals with Groom Law Group, an employee benefits law firm based in Washington, D.C. Gentlemen, great to talk to you as always. Thanks for joining us on the program again.
Thanks for having us, Jeff. I know it's into December, the holiday season, a holiday season like no other, but certainly the world keeps on turning. And, hopefully this time next year, we're back to a nice normal end of year and everybody's saying, to the extent possible, what are you doing for Christmas? And even for some, where are you going?
Yeah, absolutely. I think a lot of us feel that way. We feel trapped, obviously. Kevin, let's come to you because there's still, even though we went to a holiday break, we had Thanksgiving. You gentlemen were kind enough to come on the podcast, but a lot going on in Washington, D.C. in terms of funding.
Yeah, so there's a lot going on in D.C. in terms of funding. And this is a topic that we probably talk about semi-annually because that tends to be how spending bills tend to get done. But as of now, the government is funded through December 11th, which is Friday. And if they don't get a spending bill done, we would have one of those government shutdowns that we have from time to time. Now, right now, it doesn't look like there's going to be a government shutdown. Both Democrats and Republicans have indicated that they do not want a shutdown during the pandemic, which, I agree with both sides on that one, that, a shutdown would probably not be helpful given everything that's happened in 2020.
Mm-hmm. Go figure.
Where there's some disagreement is what should be included in the funding bill. And kind of the issue here is both Republicans and Democrats have said they would like to include some COVID relief as part of the spending bill. And that's great. It sounds like both sides agree. Republicans want COVID relief, Democrats want COVID relief. Well, it breaks down at that point. The last COVID relief bill was in April. We did a week-long mini-series talking about what was included in that bill, the CARES Act. And since then, there's been kind of this divide where Republicans have said, we want to do something that's like less than $1 trillion. Democrats had a bill that was roughly $3 trillion. And to paraphrase, I'm forgetting the name of the congressman from the 80s, a trillion here, a trillion there. Pretty soon you're talking about real money. And what we're seeing now is the Senate moderates, which is a coalition, like a group of Senate moderates from both sides of the aisle, Republicans and Democrats. They put their heads together. And this week they introduced their own proposal for COVID relief that would be designed to get us, into the beginning of next year where, if more relief is needed, they could reevaluate where we are in terms of vaccination, where we are in terms of the pandemic. And their proposal comes in around $900 billion with a B. And it has a mix of things like aid for the states, liability shields for employers. Now, there's still some details that need to come out. But what's going to be interesting in the benefit space is we're going to want to really see if some of those benefit provisions from the CARES Act that expire at the end of 2020 are extended into 2021. So an example of this would be, under the CARES Act, people who have, a hardship event due to COVID were allowed to take out $100,000 for the hardship instead of the usual $50,000. Mm-hmm. Now, that expires at the end of the year. I think back in March and April, we were hoping that the pandemic would also expire at the end of the year. But it's looking now like it's going to at least continue into the beginning of next year. So it's going to be interesting to see if that gets done. In terms of aid to the states, the pandemic's put a lot of pressure on state budgets, which in turn have put some pressure on funding for some of the state retirement plans. So I think there's some hope on the Democratic side of the aisle that there'll be more aid for state and local governments to help them meet their pension obligations. There's a whole bunch of other things that could be included. So it's going to be important to watch this week to see if Congress can get their act together and keep the lights on. I think they will. 2, if they can actually provide some I don't want to call it gifts for the population around Christmas, because ultimately taxpayers bear the cost of government funding. But if they can provide some aid in this time of need, and then to see does this have an impact on how people are able to not just weather today, but save for a secure and dignified retirement. David, you've been pretty quiet. Do you want to prognosticate? I've speculated what the options are. Do you want to pick the conclusion, pick the outcome? Guess what's going to happen?
My prediction, which could be 100% wrong, given at this moment, is, Kevin, you make it hard on me because you leave me the prognostication. So I had to figure out what's going to happen here. My personal guess right now is we get some type of deal. I hope for like a broad-based spending bill to take us through the end of the fiscal year. I think there's a much higher chance of a continuing resolution, even though people say they don't want that. We don't get anything super special. Everything goes in circles and nothing big happens. But that's the cynic in me. So bah humbug to all. But the hopeful side is.
David, you're predicting, is that your stocking full of coal?
It's Armageddon. Armageddon.
What's your stocking full of presents scenario?
Well, you talk about stockings full of coal. I could talk about the movie Outbreak too, if you like. But putting that aside, I think that I think there is a chance there will be a deal here. But I just think that things are just so messy. I can't prognosticate anything and take any responsibility. Oh, wait, I sound like a politician, and that's a good way to end.
All right, guys, so take it to the bank. David says there's a possibility of a deal. Place your bets on maybe.
There you go.
Thank you so much. I'm really proud of my position on that.
David, Kevin, thank you so much. I mean, obviously, we're making light, but we don't mean to. It just seems absurd in so many ways that, given all the circumstances, that Congress couldn't come to some conclusion. But I guess like anything else these days, we're going to wait and see. Gentlemen, a pleasure talking to you as always. Enjoy the rest of your weekend. We'll talk to you again next week.
Thank you so much, Jeff.
Bye-bye. Well, that wraps up this episode of BRN Sunday. I want to thank all of our great contributors this week. Don't forget, we're back again tomorrow on BRN AM. I'll be joined by Inside Higher Ed's Rick Seltzer. We'll be talking about the latest news in higher education. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.